Welcome to our second quarter video update for the year 2022. Today, I have with me my fellow portfolio manager on the private wealth team, Maria Dawes, as well as Glenn Murray, Chief Investment Officer and President of Capstone Asset Management. Welcome, Glenn, and thank you for joining us again. We have quite a lot of ground we want to cover today, so let's jump right in. Maria, why don't you start us off with our first question to Glenn?
My pleasure. So Glenn, you recently went on a business trip to Africa. Do you want to tell us a little bit about the investment opportunity that led you to this site visit and what the next steps are?
Yeah, thanks, Maria. I'd be glad to. As many of our clients understand, Capstone has looked at investment opportunities with a value-based lens. That is, we try to find investments that are not only valued well from a financial perspective, but also align with our values as a company. More recently, we have been actively looking for investments where we can extend this further than simply aligning with our values, but also having a tangible impact. This impact, it could be on things like the local community, the environment, or poverty. It's within this context of impact investing that Capstone is partnering with Kinvest Venture Partners to provide an agriculture investment strategy to our clients. This strategy will have the specific objective of having a tangible impact in the local community by helping to address poverty, equality for women, as well as environmental and economic sustainability. The investment will acquire and cultivate agricultural land by growing crops such as chili peppers, passion fruit, coffee, and macadamia nuts. These investments are going to be made in Rwanda, and thus the trip to Africa, and we'll be drawing on workers from the farms from the surrounding communities. So at the center of this strategy is the driving purpose of having ownership of these lands ultimately transfer into the hands of the local farm workers. So the trip to Rwanda was a chance to spend time planning and strategizing around this opportunity and to visit an operational farm that Kinvest is already running through its nonprofit entity. The nonprofit organization is currently erecting the equivalent of marketplace structures that will provide a central place of exchange and commerce for the local population. These marketplaces will serve the needs of their community, while the farms will complement this through the wealth creation provided by the job opportunities on the farms. As an example, the current farm is in a region that has approximately 70,000 people from which to attract workers. Of all these people, the 50 individuals employed by the farm are the only ones with a full-time job that guarantees work and pay every day. So Capstone is excited to be able to bring this opportunity that can provide a solid investment return and have a tangible impact on both individual and community lives for years to come.
Thank you, Glenn. I want to move on now and talk about inflation. This was actually discussed by Maria and I on our last segment of Your Wealth Matters. So maybe you could speak to some of the assets or asset classes that we would consider to be inflation protected, perhaps by passing on price increases to consumers or through other means, and whether that is a focus when evaluating investment opportunities.
Now, today we find ourselves in an environment of inflationary pressures that is causing several challenges to everyday lives, and the impact and the risk of inflation is an area that Capstone takes seriously. However, I tend to be a little cautious with defining investments as inflation protected, as it potentially gives a sense that inflation won't impact the investment. There are investments that can insulate to different degrees, but inflation is a far-reaching economic influence that most things are impacted by to some degree. To add some color to this comment, we can discuss the decisions of the central bank in response to the rise of inflation. We all know that the central bank has raised rates in an attempt to bring inflation under control. The basic idea there is that by raising rates, it's going to cool the economy. However, cooling the economy will have consequences to investments and investors. So one direct impact of these increases in central bank rates is on the bond market rates, particularly short term, which has a knock-on impact to the mortgage rates. So If we look at our mortgage investments, a high proportion of these have a variable rate, which results in them moving up with increases in these interest rates. From this perspective, the mortgages have protection from inflation. However, if the rates go up too high and stress other parts of the construction industry, such as building costs or home buyers pausing or delaying purchases due to rate and market uncertainty, then there can be a knock-on impact that the mortgage isn't protected against. So the flexible rate in our mortgage definitely insulates the investment, but it is only part of the protection needed. So if we continue with the central bank action, if the causes of inflation are supply issues, then the bank's action, which is primarily addressing demand, doesn't necessarily fix the problem and can have additional implications that would affect investments broadly due to the impact on the economy. For this reason, if the key contributors to inflation today are a result of the impact from such things as supply chain issues related to COVID, the war in the Ukraine, and or China's zero COVID policy, then the central bank's policy will likely cool the economy and demand, but may not really address the causes of inflation. Finally, monetary policy's impact tends to lag, and inflationary numbers are also lagging indicators, meaning the risk of the central bank's decisions overshooting the objective is reasonably high. So the ability to manage a soft landing is a challenge with a low probability of a successful outcome. This will negatively impact the economy and has broad impact on investments. We're already seeing the impact on the bond market, where long bond rates have already begun to come off mid-June highs, and the commodity markets where prices are off their mid-May highs. The US has now had a couple of negative quarters of growth, and there are signs of slowing in the employment market. All of these indicate that there is a slowdown happening in the economy, and although inflation is a problem, potential unemployment could hurt more. It's really probably a long-winded way of saying that inflation protection is part of the picture, and therefore I advocate for using the same principles of investing during both volatile and stable times. That is the inclusion of non-traditional assets, which can provide both balance to a portfolio, but also some of the inflation insulation to the overall portfolio's risk mitigation. Fixed income strategies provide insulation to the impact of inflation through low exposure to traditional fixed income by maintaining short duration on the holdings that we do have. We have exposure to floating rates through both our mortgages and private debt. There is contracted cash flows through leases in aviation and a new US barge investment, along with our exposure to farmland. This highlights a few of the strategies in the fixed income space that are providing our investors protection against inflation and diversification with income streams in the face of a recession or economic slowdown. On the equity side, real estate typically mitigates inflation over the mid to long term. And this, coupled with some of the characteristics of private equity during market volatility, has provided benefit to the non-traditional equity pools portfolio during the recent volatility in the equity market. Finally, I think you always consider the full benefit of investment within a portfolio. If we are in an inflationary period, it obviously becomes a larger talking point, but the inclusion of investments with differing characteristics should be a continuous process of evaluation to balance a portfolio well.
Thanks, Glenn. So let's move on to the traditional markets if we could. There is continued uncertainty and volatility in traditional markets, and even outside of traditional markets. What is our investment management team doing in terms of stress testing the funds? And as a part B to that question, how much cash do we try to set aside in order to take advantage of market opportunities as they might present themselves?
Thanks, Maria. Another two-parter. That's great. So we'll start with the stress testing, which really is a process by which we look at the impact of various assumptions on the performance of an investment. This is currently getting some traction due to the increasing interest rate and inflationary environment that we are currently experiencing. However, this is a process that is commonly performed by investment managers to understand the impact of various theoretical scenarios on an investment. Within Capstone's funds, we work with other partners on many of the investments, and stress testing is being performed on them to determine the impact to the investment, and particularly from an interest rate increased environment. A more tangible example of this stress testing can be seen with our mortgages, where we're able to run scenario analysis on the construction mortgages based on moves in prime rate, the cost to complete, loss of pre-sales, and price reduction to existing inventory to determine the margin remaining within a particular mortgage. For mortgages that are still in the site plan approval phase and pre-sales, we can measure the cushion that is available if there is a price drop on the land valuation to determine the margin of that cushion. Obviously, as I've stated, these are always based on internal assumptions made by the management team, so the output is only as strong as the inputs used. However, in the current environment, it is prudent to be using conservative assumptions, that is, higher rates, higher costs, and lower revenues. With respect to the setting aside of cash, we don't have a specific amount that we set aside in each of our funds, as it's very much a mandate-specific issue. Today, a couple of our funds have some cash reserves that are built up due to strategic sell decisions, and will allow us to redeploy the capital into opportunities that are arriving or are rising, I should say, from the current market disruption. As an example, we intentionally decreased some of the exposure to traditional bonds in our fixed income pool early in the year, specifically due to the bond market volatility. It is our plan to reinvest back into that space and actually potentially soon, but didn't want to have the full exposure during the significant volatility and uncertainty at the start of the year. This example from the fixed income pool is one of the strategies we use where we sell out of positions due to current market environment and decide to hold the cash for a period as we either look for specific opportunities or we pause to allow some of the uncertainty in the market to be reduced. The other strategy is to look to sell positions when we see other opportunities and to immediately reinvest them in the new investment that we believe will better position the pool for the current environment. An example of this is in our non-traditional equity pool, where we are reducing or eliminating exposure to some positions that we believe will no longer meet the mandate's objectives, and buying investments in real estate more focused on capitalizing on the tight rental markets and the benefits to portfolios from cash flow. We are actively looking for ways to provide clients exposure to opportunities that are being created in this period of volatility and uncertainty. But just sitting on too much idle capital while we look isn't always the best way to position funds.
Thanks, Glenn. That sounds like a very opportunistic and yet prudent approach. I'd like to switch gears again and move on to a topic that is coming up quite often in my meetings, and that is real estate. So there seems to be a slowing demand for residential real estate, and with that, lower sale prices than we were previously seeing. How does this impact the mortgages that we hold, both in the mortgage funds and in the private high income pool as well?
Yeah, I think that's a fair question. And while I generally agree with the comments, I think some context for the numbers is a good starting point. So much of the headline data that we're seeing is a comparison against 2021. But I believe we can all agree that the 2021 market, and particularly the first half of that year, was not normal, or for that matter, not healthy. If we compare residential unit sales from the Canadian Real Estate Association's data for June 2022, and we compare that to June 2019, the numbers are pretty much flat. 48,176 for 22 versus 48,231 for 2019. If we look at the weighted average sale price in 22, it was 671,000 versus 476,000 in 2019. And we have seen 3 months of residential inventory in June of 22 versus 5 months in 2019. So all of this shows fairly flat or favorable difference since the pandemic. However, it's likely these numbers may continue to weaken but we do need to keep the reference points in focus when assessing their relevance. I'd also like to point out that there are areas that show a dramatic change since the beginning of the year, such as the residential sales to new listings ratio, which has dropped from 85 in January to just under 52 in June. This ratio gives an indication of the balance in the market. At 52, we would be currently in a balanced market. However, due to that rate of change that we've seen this year, it's important to keep an eye on this along with the rising inventory levels. Inventory levels is one of the items we monitor closely to understand the health of the real estate market. Some others are employment levels, interest rates, policy intervention, and the general economy. So I think that uncertainty is the major factor in the current markets. Employment numbers remain strong, interest rates have been rising, but are historically low. The economy has been performing okay, but with the policy intervention of the central bank, I believe uncertainty exists in all of these areas, and is this uncertainty that impacts consumers, businesses, and the real estate market. We've discussed in an earlier question some of the impact of monetary policy, but it is fair to also say that the risk of an economic slowdown is increasing with each policy move and has already been seen in the US economy. Should Canada slow down too much, then this will impact the employment picture, which could add to the real estate market pressures and is the one aspect I watch closely. The impact of uncertainty we have been seeing in the construction mortgage market, both in Canada and the US, is a slowing of the developers making decisions on projects to move forward. It's challenging to understand the economics of projects with unknown or unpredictable assumptions, which is causing developers to pause. The impact of this is a slowing of opportunities or the pipeline, as borrowers consider the projects that make the most sense and take their time moving from loan approvals to actual project launch. On the positive side, though, as other lenders either slow or stop due to mandate reasons, typically seen in the larger institutions, private lenders like Capstone see opportunities to lend to even stronger borrowers who can't source capital from some of their typical institutions. The construction industry has continued to function through all previous slowdowns in the market. We fully expect this to continue to be the case. We do, though, expect to see a slowdown in the volume of projects we approve, but we do expect to see much stronger projects due to the economics needing to be superior compared to an overheated market. So overall, our mortgage funds and the private high income pool have continued to provide our investors with outsized fixed income alpha in a highly volatile and uncertain fixed income environment. This has been done in an environment where we are putting aside reserves as necessary in response to the changing market dynamics. So although inflation and rate rises are of concern, it is the return to some increased certainty which will help the real estate market determine its appropriate level and how to move forward.
So Glenn, one final question for you, and I know you love these types of questions. So is the glass half empty or half full? It's a loaded question for sure, and take it however you want.
Yeah, you're correct. Not my favorite question. So I think I'll answer that by saying that there are always reasons to not invest, meaning investors can always see the environment as half empty. However, it's usually at times where things really seem the worst that there are opportunities available to investors that can provide long-term performance. Currently, I do feel that with so much uncertainty concerning central bank policy, supply chains, geopolitical tensions, and inflation, there is an overarching negative sentiment. However, I believe this is the time to be looking at how to position investments for the midterm to take advantage of this. With that said, we are looking to opportunities in private equity, real estate, and a repositioning in discrete equities. In addition, we will continue to make timely investments in our normal non-traditional markets to complement our current holdings. Overall, as I've already mentioned, our pools, when held in a balanced portfolio, continue to provide a platform to protect capital with a less volatile experience. This, in our opinion, continues to be the best way to navigate through these challenging times, whether your cup is half empty or half full.
Glenn, thank you so much for your time. We certainly missed you this last quarter. So it was wonderful to once again have your thoughts in what is a time of high uncertainty. And I know we've been hearing and saying that a lot, but it's all the more reason why your insights have been valuable and just truly spot on.
Yeah, thanks, Glenn. And many of these questions actually did come from our viewers. So we hope you've enjoyed our update for the quarter. And please stay tuned next month for the next edition of Your Wealth Matters. So goodbye for now.